Okay, good morning, everyone, and welcome to our latest webinar. For those of you joining us from around the world, I'm Soffe. I serve on the Supervisory Board of Gleeds. I also oversee our International Dispute Advisory Service. I'm a past president of the CIOB and a fellow of the Royal Institution of Chartered Surveyors and serve as a national panelist on the American Arbitration Association. I'm speaking to you this morning from Atlanta in the States with a strong cup of coffee. Once again, we've got speakers from Egypt and the UK. They're being coordinated from Australia. In July, our webinar, Construction Contracts in a Changing World, questioned whether current contracts are adequate for the increasingly uncertain times in which we live. We considered factors such as the pandemic, climate change, and political instability, and whether our contracts cater for the impacts of those events in a helpful way or not. Well, this topic certainly captured your interest and we received a great number of questions. This made us think, why not continue our discussion on construction contracts in a changing world by creating a case study? One not based on a real project, but more to reflect our experience and represent what we consider could be issues commonly facing projects right now, and most certainly in the near future. The world simply needs a huge amount of new infrastructure over the next 20 years, not only in developing nations, but also upgraded infrastructure in developed countries and in Europe and the US. Somehow, we will all have to meet the delivery challenge. That means we'll have to better adapt to the changing world in which we live, with contracts that are better geared towards dealing with unforeseen events, and also contracts that are structured to be generally more fair and more collaborative. It's our strong view that projects that continue to use the same old contracts are likely to face the same old difficulties. A recent global construction disputes report found that for the second year running, that the #1 cause of disputes was parties failing to understand or comply with their contractual obligations. Meanwhile, another leading report stated that the global average value of disputes has increased. That brings us to our first poll. I'd like to ask the audience for their views on this question. What is the approximate average value in US dollars of construction disputes globally in 2020? That's per each dispute. Is it $15 million, $35 million, or $55 million? And I give you a few seconds to answer that. Okay, let's see what the results are. Most of you said 35 million, followed by 55 million and then 15 million. In fact, those who answered C are correct. The report stated that the global average value of disputes increased to 54.26 million in 2020. It seems to us that the cost of number of disputes is only likely to increase further if the contracts we don't deal with, if the contracts we use don't deal with unexpected events very well. And if the parties using them don't understand them, let alone comply with them. In our case study today is aimed to show some of the issues that the parties may face. Before we begin, let me set the scene on this fictional case study, which is based on our experience, but not based on any specific client or project. The project is for the design and construction of a new national museum in a Middle Eastern country. The design is to be iconic and requires vast quantities of structural steelwork, much of which is exposed to feature the architectural design. The project was let on the basis of a lump sum FIDIC Yellow Book 1999 contract, subject to the owner's standard amendments, which were limited in number, but shifted substantial risk to the contractor. After 3 months, the cost of structural steel into the project, 3 months into the project, the cost of structural steel increased tenfold due to the shortages of raw material globally. Then 6 months into the project, severe storm conditions suddenly hit the country, causing flash flooding of the site and washing away the foundations and groundworks, which were nearly complete. So some really quite radical events there imposed on the project. To make things more interesting, our panel will answer the questions from two perspectives. Firstly, on the basis that English law applies to the contract, and secondly, on the basis that the local civil code applies to the contract. The contract is exactly the same, but in doing this, we'll demonstrate how the choice of law can be an equally strong influence on a project, just as much as the choice of contract. We'll spend about 45 minutes discussing those questions. We've allowed about 15 minutes to answer your questions at the end. Please feel free to tell us about the issues you're facing on your projects. We welcome your thoughts on our case study. Please submit your questions using the question and answer form on the Zoom site, and we'll attempt to get to as many as possible during the question time. Our panel today, again, consists of legal and technical experts from Freeths and Gleeds. This is a good point to remind you that Gleeds and Freeths have combined on our construction disputes A to Z initiative, which we launched last year. We've made available our marketing material on this initiative as a handout for this webinar. This initiative is enabling us to offer our clients a one-stop technical, contractual, and legal advice. If you have any questions raised by the webinar where you think we could help, please don't hesitate to get in touch with us at advisory@gleeds.qa. That's advisory@gleeds.qa. So let's move on with the main business, and I'll let the speakers introduce themselves. Alex?
Thanks, Chris. Good morning, everybody. Good afternoon, good evening, wherever you are in the world. I've seen Qatar, I've seen Egypt, I've seen Vietnam pop up in the comments, and no doubt there's more besides, so welcome. I'm Alex Johnson. I'm a partner at Freeths. I'm a lawyer. I specialize in construction and engineering law. I'm based in the UK, but my practice is international. So I've got experience of projects around the world, and I worked on a number of construction disputes in the Gulf region and the wider Middle East, as well as for clients who are based in Western Europe and the USA. I deal with the full life cycle of construction projects, although predominantly I handle conflict avoidance and disputes, including international arbitration. But I also draft and negotiate contracts on behalf of clients, and I advise them on issues that arise during their projects as well.
Thank you, Alex. John?
Hello, everyone. I'm John Refat. I'm a director of Gleeds Egypt. I'm a chartered conservator and member of Chartered Institute of Arbitrators. I'm also a board member of Egypt RICS Advisory Board. I have 20 years of international experience in the field of project and cost management, dispute resolution, and high-profile projects within large developers, cost consultants, and first-year contractors at senior level in the MENA region. Thank you, Chris.
Thank you, John. So just a little bit on questions policy. Please remember to submit your questions in the Q&A box, and we'll leave time at the end to answer them as much as we're able. Past experience tells us we won't get to them all, so please feel free to email us or send questions to advisory@gleeds.qa after the webinar. So questions on the case study. I'll put questions to Alex and John shortly, but before we do that, I wonder what our audience will think will happen under the contract in response to the first event, the 10-fold increase in the steel price. Let's run a quick poll to find out what you think of this one. So how is the risk for the steel price increase allocated under the contract? Remember, we're talking about FIDIC here. So employer's risk, contractor risk, force majeure, or something else. And we'll give you about 30 seconds, 20 to 30 seconds to answer that. After which time we'll ask the expert. Okay, let's see what we've got. So the majority have said contractor's risk. Some have said employer's risk, only 10% force majeure, and 11% have something else in mind. So Interesting results there. Any comment on that, Alex?
Yeah, it looks like there's a few pessimistic contractors on the webinar today, but I mean, they may well be proved right. Let's see.
Yeah. So let's do the first question. So 3 months into the contract, the price of structural steel has increased tenfold and the contractor is committed under a lump sum. What can the contractor do? I'll start with you, Alex.
Yeah, thanks, Chris. And I'll be answering these questions as if the parties had agreed that English law governs the contract. I mean, such an increase in steel prices is clearly a huge problem. And assuming the increase in the steel price puts our contractor out of pocket rather than out of business altogether, then there's a few strands to this answer. It's not quite a multiple choice answer, but I'll walk you through it. So let's start with how English law views contracts. Basically, the position under English law is that parties are bound by the terms of their contract, and the certainty of contract is part of the appeal of English law. And it's a reason why international parties commonly apply English law to their contracts, even though the project and the parties themselves might be based somewhere else in the world. English law has well-developed legal principles of construction and engineering law that have been exported around the world. And even where a local civil code governs the contract, parties often turn to English lawyers for advice on the underlying principles. And we work together with local counsel to do that from time to time. And the certainty of contract means that the English courts are very reluctant to interfere with the deal that the parties have made. So in the vast majority of situations, the starting point for any answer to a question under English law is, let's look at the contract. And had the parties used a FIDIC 99 contract in its unamended form, clause 13.8 would have been highly useful. This is a clause that allows for adjustments of the amounts payable to the contractor for rises or falls in the cost of labour, goods, and other inputs to the works. And there's a formula for calculating the addition or the deduction of the amount. And because goods, being a defined term, includes materials, which is also a defined term, those are things intended to form part of the permanent works, also a defined term, this will include the structural steel. So clause 13.8 would provide for adjustment of the amounts payable to the contractor based on cost indices. So sounds pretty simple, but clause 13.8 is typically deleted from the FIDIC when owners amend the yellow book and interject their own amendments. So the reason for this is obvious. Owners who require a lump sum contract don't want to pay the contractor additional amounts for changes in costs that are based on rise and fall in market prices. And for as long as I can remember, no matter what the form of contract, owners have always expected contractors to bear the risk of cost escalation. And so fluctuations clauses such as this one typically don't get included in the final contract. So if that clause is not available, then the contractor has to consider whether there is a contractual entitlement to additional payment. And now a quick scan of the entitlements throughout the FIDIC contract in its unamended format show that none of the events are really likely to capture an increase in the price of materials, no matter how dramatic the increase. So to obtain an additional payment under the contract, I think the contractor would have to show that the employer's actions caused the contractor to suffer the increased costs. And that's probably difficult unless there are particular circumstances exist. For example, if the employer delayed access to the site, in which period of time the price is escalated, I think that would be the employer's risk. But this overall is not a satisfactory position for the contractor to be in, because the contractual effect in this case is basically to make the cost escalation a contractor's risk. So well done to the 57% or so that said that. But I don't think it stops there. I think the next question which has to be considered is whether, because we're dealing with an extraordinary increase in prices here, whether the effect of that increase is so great that the contract itself has been frustrated. And when we talk about frustration, I don't mean the contractor's feelings, although frustration is no doubt one of them. I'm talking about the legal doctrine that applies where the circumstances have rendered a contract essentially impossible to perform. And English law says that a contract may be discharged on the grounds of frustration when either something happens after the formation of the contract that renders it physically, legally, or commercially impossible to fulfill, or something happens which transforms the obligation to perform into a radically different obligation from the one that was undertaken on entry into the contract. And essentially, the doctrine of frustration amounts to, this is not what I signed up for. In our case study, I think it was highly unlikely that the contractor promised to deliver structural steel at anything other than its bid price plus some contingency, but not 10 times the price in the lump sum contract. So I think it's important to consider to what extent the doctrine of frustration may apply to this contract if it's become commercially impossible to perform. Now, there's no single test as to whether the contract has been frustrated, and so the courts will consider these cases taking account of all the facts and circumstances. But generally speaking, the criteria that the courts will look at are whether the event occurred after the contract was formed. Yes, it did in our case. Is it so fundamental that it strikes at the root of the contract and was entirely beyond what the parties contemplated when they entered into the contract? Possibly, if not probably. It's not due to either party's fault. No, that's correct. And it renders the further performance impossible, illegal, or radically different from that contemplated when the parties entered into the contract. I think that's the most difficult element, and it may well be the case. It's a possibility. I don't think it's a probability. Now, while frustration depends on the particular contract in question, the courts have held that where a contract is merely more expensive to perform, that is not frustration. That's a case of Secura Glue and Noble of 1962. This was a case that concerned a 100% increase in the cost of freight shippage charges. And the courts have also held that changes in economic conditions are not frustration. That was a case of Gold Group Properties and BDW Trading. And in that case, property prices fell due to events that were unexpected, but they were not entirely unforeseen. And the contract included a mechanism that allowed it to operate in more difficult economic climate. In our case, although the tenfold price increase is clearly more than the 100% increase in the Noble case, it seems that, especially in our changing world, substantial price increases, while they're unexpected, are probably not unforeseeable. Frustration is a very high bar to clear, however, but given the scale of the price increase in this case, I think there's an argument that the contract was frustrated, but it's not certain. And what that demonstrates is that in today's world, parties really need to include contractual mechanisms that deal with cost escalation, because continuing to treat this as a contractor's risk is a good way to delay and disrupt projects, and a good way to create further disputes and increase that figure of $55 million year on year. So I think parties need to realize that they both want to complete the project, so they have a shared objective, but that won't happen on schedule and on budget if the contractor becomes insolvent due to price increases. So I think in our more uncertain world, because this looks like a contractor's risk, we should not simply continue to ignore cost escalation issues, and the problem should be dealt with in the contract. Thanks, Chris.
Thank you, Alex. And it takes me back with my career back to the 70s, where we had escalation contracts and the formula or basic price list to adjust contracts, because inflation was running at over 15% at times. John, it sounds like frustration under English law may be very difficult to establish. So how might things be different if, say, the Egyptian civil code applied to the contract?
I'm not a lawyer, Chris, so my answer is purely dependent on my experience within the Egyptian markets. There is a lot of similarities. I see it on the way how civil code and common law treat frustration of the contract. However, there is a key difference, which is Article 147, which despite respects the free will of parties going into a contract by stating that a contract is the law of contracting parties. It cannot be nullified or amended without the agreement of these parties or the causes specified by the law. The doctrine of unforeseen circumstances is preserved in this article, which stipulates that when, however, as a result of exceptional and unpredictable events of a general character, the performance of contractual obligation without becoming impossible became excessively onerous in such a way as to threaten the debitor of excessive loss, the judge may, according to circumstances and after taking into consideration the interest of both parties reduce to the reasonable limit the obligations that have become excessively any agreement to the contrary is void. Article 147 grants the Egyptian courts a discretionary power to reduce, considering the circumstances, onerous obligation under the contract. This discretion cannot be excluded by contract. It's a forcing. The term excessively onerous is expressly stated to be of a standard lower than impossibility. However, the event must be of a general character and must be exceptional. Egyptian judicials, these decisions have held Article 147 to apply to emergency occurrences to impact and effect, which are of general application and which are impossible for the ordinary person to predict or foresee, regardless of whether the particular contract counterparty have predicted its occurrence or not. This is a very civil code type provision. I don't think there is similarities in the common law, and shows that if the steel price changes to the extent threatening the contractor with excessive loss, the law could step in and reduce the obligation. I believe, according to what Alex said, there is no equivalent to this in the English common law, which is very reluctant to step in and rewrite a contract. On the other hand, under Article 373, it addresses the force majeure and stipulates that an obligation is terminated if the debitor establish that its performance has become impossible by reason or of cause beyond his control. The standard in this instant is higher standard of impossibility and not merely an obligation becoming excessively onerous. Where a contract is terminated by reason of impossibility of performance, obligations are terminated and the contract is cancelled. By contrast, the underlying contractual obligation in respect of which Article 147 relief is granted are not terminated, but are adjusted to restore the economic equilibrium of the contract. So there is, with the exception of Article 147, there is a lot of similarity, but still the law in the Egyptian market can step in, or the Egyptian law can step in this case.
Thank you, John. That's very interesting. So excessively onerous is a lesser standard than the doctrine of impossibility, and of course, the courts may rule accordingly. The problem there is, of course, how long does it take you to get relief and have it sorted out by the courts? So again, I'll put our questions to Alex and John shortly, but before we do that, let's quickly ask our audience, what do you think will happen under the contract in response to the second event, the heavy rainfall and flooding? Let's run another quick poll on that. So poll number 3, what is the flooding risk? How is the flooding risk allocated under the contract? Is it employer's risk, contractor's risk, force majeure, or frustration? And we'll give you 20 to 30 seconds to answer that and see the results. So thank you for your answers. So the vast majority, 75% of you, think the force majeure is applicable to the flooding. Second highest, contractor's risk. Third highest, 8% only for employer's risk, and 4% have said frustration. So Alex, what about this issue? Rainfall hit the country, causing flash flooding of the site and washed away the foundations and groundworks, which were nearly complete. What happens next? Again, under English law, I imagine.
Yeah. I'll look. This is from the English law perspective, and I'm not surprised that there was so much support for force majeure that time around it. It very much leads you to that conclusion. I think there's a couple of things that I'll explore that might take you away from that conclusion, but I expected a lot of love for force majeure there, and it's good to see that that's what the audience thought as well. So again, English law position is you go straight to the contract. It's worth just mentioning that force majeure under English law is a creature of contract. So if you have no force majeure clause in your contract and English law applies to it, you are into frustration, because there is no common law concept of force majeure. It's a contractual thing. Fortunately, FIDIC includes the force majeure clause, which is the obvious starting point, as the audience rightfully suggested. So let's remind ourselves briefly of the FIDIC definition of force majeure, which is found in clause 19.1. A force majeure event is an exceptional event or circumstance which is beyond a party's control, which such party could not reasonably have provided against before entering into the contract, which having arisen, such party could not reasonably have avoided or overcome, and is not substantially attributable to the other party. So on the face of it, as the audience predicted, I think quite rightly, flash flooding would seem to meet that definition. And my own experience is that Middle Eastern conditions are generally hot and dry, but on the few occasions when it does rain, the rain can be quite disruptive and cause problems with infrastructure such as roads and drainage. So I think in those circumstances, the party might struggle to show that the event was exceptional unless the rainfall exceeded what might be considered even usual rainfall for the few times in a year when it does rain. You can see now there is a lot that's going to turn on that exceptional wording. Now, the list of exceptional events or circumstances given in clause 19.1 don't seem to help. Heavy rain does not simply fall, I think, into the category of a natural catastrophe in 19.15, because that refers to earthquake, hurricane, typhoon, or volcanic activity. And obviously heavy rainfall could be the result of a hurricane, but it doesn't seem likely that it fits neatly into clause 19.15. I think we could also scan around the contract and see what else might help. If we look at the employer's risks under clause 17.3, those include any operation of the forces of nature which is unforeseeable, the capitalized U, or against which an experienced contractor could not reasonably have been expected to have taken adequate preventative precautions. And again, the key word here is unforeseeable, which FIDIC gives a definition to, which is not reasonably foreseeable by an experienced contractor by the date for submission of the tender. So again, I think there's a lot around here about the question of whether the event was truly unforeseeable by that definition, or whether it was always a risk of happening, but a low risk of happening. Another point to consider, I think, is whether the flash flooding amounts to exceptionally adverse climatic conditions, which gives the contractor an extension of time event under clause 8.4c. Again, I think there are similar difficulties showing this was exceptionally adverse as opposed to just something with a probability of occurring, but a low one. Although I've more confidence in the contractor's position under this clause, because it seems to me that this could be quite easily demonstrated to be exceptionally adverse climatic conditions as long as the records existed to show that. But this isn't particularly helpful for the contractor because this is, of course, a time-only entitlement, and it doesn't allow the contractor any additional payment. And that's the same as force majeure. Force majeure is time only unless the contract says that the contractor does get an additional payment. So I think a lot depends on the evidence that the contractor could produce by way of records, weather records, to substantiate that the flooding event was exceptionally adverse, unforeseeable, exceptional. I think there's a decent possibility that it could just simply be a contractor's risk, particularly when you look at the way owners amend FIDIC contracts. And so some of those more contractor-friendly protections, such as clause 8.4c, are commonly deleted. So I think it's useful to turn again to frustration. The courts have found that destruction of the subject matter of the contract has amounted to frustration, and that sounds fairly obvious. Appleby and Myers is an 1867 case which held that contract for the work and supply of materials was frustrated when a fire destroyed the premises on which the works were being carried out. So there's some similarity in our example, because Chris said at the outset that the washing away of the work that had already been performed was a result of the flooding. And so in that sense, it seems unlikely that the contract is impossible to perform because it can be reperformed, but it has, of course, been severely delayed and severely disrupted. I think it's worth mentioning here the role of insurance, because the practical resolution of this problem is probably through the contractor's constructional risks insurance. But again, the point that we're making is there's no satisfactory answer to the question under the contract if an event such as this occurs, which is an event that's serious, but it's unlikely rather than exceptional. And in the changing world we live in, I think we are seeing a higher frequency of what may once have been described as exceptional events, and I'm referring here to climate change related events, but that will render them unexceptional over time. And our contractual language, I think, when we're using, the 99 FIDIC contract, which is 20 plus years old, I think it struggles to embrace events that are serious, but where the probability of them occurring is exceptional, is not exceptional, but rather just unlikely. And again, I think in today's world, we need to consider these issues more specifically in our contracts. Perhaps not so much for the Middle East in terms of this extreme example. Our example was extreme to illustrate the point, but if you take Western Canada, for example, in the last 6 months, that region has been hit with both extreme heat and yesterday extreme flooding. And it's those kind of issues that I think our contracts struggle to accurately deal with. Thanks, Chris.
That's interesting. Thank you, Alex. And just to expand on that question, John, might anything be different then in this example if the Egyptian civil code applied rather than the English law?
Yeah, Chris, as always, I will go first in a construction contract for the contractor to determine if there is any entitlement for additional time or money for the contractor where it works have been impacted by adversely weather condition. However, it is common for parties, as we all have experienced under construction contract, to depart from standard conditions and agree amendments or bespoke conditions, which displays the original disruption of risks slightly different, which might lead also in resulting in a lesser entitlement for the contractor, or alternatively, a contract which is silent on this topic. In such circumstances, where there is no entitlement raised under the contract, a contractor may consider relying on additional rights available under the Egyptian civil law. The problem, as Alex was stating, the key challenge here is to establish the availability of legal basis for such claim. Will be seeking to establish that the weather experience was exceptionally adverse or extraordinary, which can vary from region to region and over time. If the floods experience in such case is more frequent, the argument that they are exceptional could be swept away. In the absence of a definition in the contract for exceptionally adverse or extraordinary weather condition, there is limited guidance available under Egyptian law. However, the Dubai court have under a case number 443, I remember, which was dated December 1998, has provided some guidance in the context of a force majeure claim, which described the weather as to be exceptional, that it has to be exceptionally poor, not expected and unavoidable. So this is the definition which the Dubai court came with. Weather is considered exceptional, while will first have to be measured again a sort of a benchmark, which is usually expected to be in particular locations at that time of the year. And the question asked, was this weather expected or foreseeable, given the varying and unique climates found in the Middle East especially, which can include lightning storm, typhoon, sandstorms, and the evolving debates relating to climate change and cloud seedings. This answer will vary from region to region again and may not be always clear. Once it's established that the weather was exceptional, the question then has to be asked whether it was adverse. So this will require the contractor to demonstrate that the weather was the direct cause of the delay for completion, not beside other reason, or it triggers some other provisions entitling the contractor to monetary compensation. There are various provisions under the Egyptian civil law which deal with force majeure, which might include severe adverse conditions, including Article 373, which we talked about, Article 664, which deals with force majeure events that make the performance of contract impossible. However, the general remedy of such provisions is the termination or cancellation of the contract, which is impractical and disappropriate solution for the majority of the contracts, especially construction contracts. Unfortunately, under Article 665, it states that if an object breaches due to a sudden accident before it is handed over to the employer, the contractor shall not claim the cost of works or reimbursement of his expenses, which again, to me, is underscoring the need and importance of a contractor or risk policy, and which is you need to insure your work, because at the end of the day, it falls up to a contractor risk according to this article. Again, I'm not a lawyer, I'm just saying this from my experience in the markets. If you want to comment, Alex, please feel free.
No, absolutely. I agree with all of that. No, I mean, you might not be a lawyer, John, but you make the good point, which is, you need to get those CAR policies in place without a shadow of a doubt.
And I noticed a similarity there between the exceptional being swept away along with our foundations.
Yeah.
Okay, third question, Alex. Should the parties be thinking about to make their contracts more responsive to these types of events? So how do we set this up for in the future?
Yeah, thanks, Chris. I think essentially, I think parties need to consider the specific risks that the project faces, and to ensure the contract addresses those risks in a satisfactory way. And that sounds a bit, simple or obvious, but I think what it means is doing the risk analysis and making it as broad as possible, so that it doesn't just consider the project specifics, but it considers the broader climate, the political, the economic, and the other factors that could impact upon the project. Now, obviously, that's not needed for all projects in all cases, because it's all dependent upon scale of the project, type of project, etc., etc. But I think the larger the project and the more important the project, the more attention this should be given. And I think parties in today's world should be considering issues such as, whether the supply chain is robust, are there weak links in the chain? Can materials be procured locally instead of shipping them from another country? Is there an alternative if the primary supply fails? Is the project in a region that's susceptible to flooding? And if it is, what are the contingency plans? And our case study example was necessarily extreme, but it was used to make the point that contracts that haven't been tailored for the particular project based on such a broad analysis of risk will probably continue to deal with exceptional events in an inflexible, rigid, and as we've demonstrated, ultimately unsatisfactory way. And if we just pick on the issue of price escalation, not from the case study, but from what we're seeing today, there are a number of reasons why prices have increased through 2021, and mainly they're related to the pandemic. So, shutdowns that meant that supply chains didn't produce the goods and materials at the same level as they did previously, increased demand as a result of economic activity opening back up again. There was the point about ships and containers and crews all being in the wrong position. And all of these disruptive factors that are the result of the pandemic are on top of things that will always impact upon prices, such as inflation, oil prices, and extreme weather events. And so I think as a result of all of that, what we're seeing in our experience is contractors requesting fluctuations provisions to be included, which seems the right thing to do, but there seems to be a remaining resistance to including them from the owner's perspective. So what we tend to see are contractors requesting clauses that relieve them in terms of extension of time, and which compensate them by way of additional payment where a certain trigger point has been reached. So, for example, parties could agree that a contractor will receive compensation when material prices reach a certain threshold, but only where they've used best endeavours to avoid or minimise the impact. For example, going to an alternative supplier. Similarly, in relation to weather events, which I think parties are perhaps less keen on amending contracts over at the moment. I think parties are advised to consider specific issues in terms of time and money, and not just rely on force majeure type provisions, because first of all, there's a chance they might not apply. And secondly, if they do apply, that's time only generally, not money as well. And this year we've seen, as I mentioned, extreme heat on the west coast of the USA and in Canada and in Southern Europe as well. There's been severe flooding damage in Northern Europe and New York City. And I think in future, if not now, these events are unlikely to be exceptionally adverse. I think that wording just isn't going to work. And also it doesn't really fix the problem. So as part of the pre-contractual analysis of risk, I think it's prudent for parties to consider things like historic weather records, but also look at the recent events and factor in the probability that those recent events may reoccur. So, logistics planning is very important. And the impact of not doing this could be significant. So if the contract doesn't contain specific drafting, extreme weather events might not automatically lead to compensation. And you might say from the owner's perspective, what does that matter? But I think owners can't avoid a share in this risk, and it may be prudent for them to include acceleration provisions or recovery catch-up type provisions, particularly if the contractor is allowed some relief for certain events. And that might include agreeing a share of acceleration costs up front, for example. Because, as we mentioned before, if parties change their mindset from an adversarial position, which is trying to shift the risk from one side of the table to the other, and think about putting the project at the center of the table, and then think about how the risks can be more equitably be managed, I think we're on the way to better contracts and therefore less scope for dispute.
It's interesting, Alex. So it comes to mind there where, in a project management role, we would always be doing some sort of risk register after the engagement and after the contract. You can almost see a risk register being examined and worked out between the client and the owner and the contract parties the contractor and the owner and the contracting parties before you sign the contract. You can see a risk register being the vehicle to assess those risks realistically and professionally based on what might be coming at us. So still on the third question, John, what are your views on what parties can do to practically to identify project risks at the outset? And maybe I've answered that a little bit, but carry on, please, with your thoughts.
Chris, identifying the risks in a project is critical. It needs to be done properly to manage them successfully, because all projects are different. And the best way of identifying potential risks within a complex project is to call on the experience of past projects within the same field. Even within different industries, there are many areas of potential risks that can be the same or similar. The first approach, I would say, is to take a broad overview of the different areas of the project, then take each section and break it down to a finer detail. I would say a brainstorming session within a small group of team members representing different parts of the departments or group of project stakeholders involved in such a project would be helpful. Some of the different areas that can be considered in such a session is scope definition, because there is a problem with generally which we experience on poorly defined business requirements, lack of experienced staff documenting the requirements, business requirements needed but not approved by the business or being higher or lower than needed, benchmarking, especially on the budget part. Anything that has not been done before is likely to pose a high risk, particularly if the existing data is exclusive. So there is no experience to call on from the previous projects, neither inside or outside the organization. For example, in Egypt, they are building nuclear power plants. It's called a Dab'a, and this requires to attract specialists from abroad to contribute to this process and the risk register of it. Also, I would say human resources, that knowledge of the makeup of the project teams can greatly assist in assessing potential projects. Do they have specific knowledge? Do we require specific expertise that we might need to find elsewhere? The time scale, how accurate are the estimates for the whole project and each individual task have been estimated? Is the project unlikely to go beyond the expected time? Has the business imperative driven the time scale, such as in cases where time to market ahead of completion is overriding factor? We see this a lot on malls, for example, hospitality sectors, where there is a soft opening dates, which is fixed, and regardless when we will start, we will still need to achieve this date. So sometimes acceleration is not actually the solution to everything. Also, on a budget perspective, how accurate the estimates for the whole projects and each individual task have been done. Has the budget been determined by a business imperative as well, or just an actual cost? So is it done properly, or we have been set to design to cost benchmark, which sometimes due to business requirement will not achieve 100% of the required? And we come to the biggest currently risk factor I see in the Middle East in general, or the world in general currently, which is procurement, workforce, and supply chain. There is increased activities within the Egyptian market and in the Middle East in general, KSA and other locations, especially in infrastructure and affordable housing projects. Egypt is the third largest economy in Africa and the second most populous currently. This is expected to impact the availability of skilled workforce, specialist industry player, which in return will influence the tender prices. I see this as an important risk that must be considered in any coming project risk register. We have been recently seeing during the past couple of weeks a huge increase in tender returns because everyone is pricing risk within their prices, expecting due to the delay in supply chain and with the New Year's and the short period. So everyone is now saying, okay, guys, we're having a problem with the supply chain. This is reflected badly on the long lead items, delivery times, cost of the things. So I think it's now more important than ever to consider a proper project risk register. Chris.
Thank you, John. That's great advice and proactive advice to getting ahead of the risks there for any project of any size, I guess, that would work for. So we've got some questions coming in now. We're going to try and answer some of them. Here's one from Donald. Who fits the bill for delays, damages to the works, etc., over and above those picked up by the insurance provider? That's an interesting one. So you have excesses and deductibles. So what happens to those costs? Alex, do you want to take a stab at that one?
Yeah, it's quite an insurance question.
Yeah.
And it all, as you say, it all depends on what's covered and what isn't covered. And typically the contractors all risks policy covers the reinstatement cost of the works, however you express that. And sometimes you see that contractually expressed as the full reinstatement cost. So, that tends to suggest it's not just the physical work, but it's a little bit more, or it could be less than that. So it all depends on the policy. And you also sometimes see clauses that will allow compensation effectively for the delay and disruption caused by this particular event, when the JCT contract would do that, which is a UK form of contract.
Yeah, interesting. There's a question coming in here, John. I'll let you have a stab at this one. Collaboration is a wonderful concept, but how will these future contracts address and allocate risk and responsibilities in the events of disputes and claims? Or is it just behavior that you're advocating?
I think it's both. It have to be written in the contract, and it's changing behavior in general, because a fair distribution of risks within the current market conditions is mandatory to have, because at the end of the day, if a project is delayed for any reason beyond the contractor control, which we are seeing in delays in supply chains and deliveries, prices and everything, flooding, for example, or adverse weather conditions, at the end of the day, both the employer and the contractor will be harmed. It's not only one party will get affected. An employer needs a project to generate revenue. A contractor needs to finish to get his payments and move to another project. So a collaborative working environment and collaborative contracts is a behavior, and it's documented. So it's more of a sharing risk towards both parties.
Yeah.
Thank you, John. Do you have anything on that, Alex?
Yeah, I'd echo that. I mean, collaborative contracts themselves are not new. They've been around for many years. There's for example, there's a contract called PPC 2000, which comes from 2000, and it's not a new thing. I think the issue has been that parties rarely use those contracts, and so the question is, well, why don't they use those contracts? And I think part of it is that the construction industry is not known for its ability to embrace change. It's quite traditional. Things move quite slowly, and so I think the real problem is, and I agree with John's comments, I think the real problem is one of mindset. There has to be the willingness to change mindset and to agree to collaborate putting aside the contract for a moment, because if you can agree to collaborate, then you can draft a suitable contract to reflect that. If you don't agree to collaborate, you can by all means enter into a collaborative contract, but I predict the results will not be good. The results will be much the same. So I do think it's a behavioral thing. And I think in terms of uptake, there are some big owners experimenting with collaborative contracts, but I think it will take those owners to start to use them to show the benefit of them in order for there to be a wider change. But personally, I think it's important for mindset to shift towards, you know, not one party's interest or the other, but what's in the interest of the project. But that means that owners can't be hands off, and it means that contractors can't be claims focused. So everybody's going to lose a little bit of what they do at the moment in order to take this new approach. So it'd be quite interesting to see what happens. I think there's every chance that next year the average cost of disputes will go up again. But over time, I would hope that parties think that this is not sustainable, and maybe there's a different way to do it.
Yeah, thank you, Alex. So we're advocating behavior and solution-driven mentality as well, and plus documentation. So there's a question coming in here, one from Hossam Lotfi. Why is flash flooding considered frustration rather than force majeure? As a follow-up from an anonymous attendee. So why is it frustration, not force majeure, Alex? Well,
I don't think it would be frustration. I think it is more likely to be force majeure. I think, you know, force majeure is one of those areas where it's either within the list of specific events, and in the FIDIC, there is no specific event of flooding, but the clause is wide enough that it, you know, the list of events is non-exhaustive. So I think as long as you met those criteria that I read out earlier, then it's likely to be a force majeure event. I think that seems, you know, that seems where the compass is most logically pointing in this contract. The point we were making, of course, is whether that's satisfactory, because okay, contractor gets an extension of time, but his costs cannot be claimed.
Yeah, and so that's a follow-up question to that. Would a legal frustration entitle the contractor to both time and cost versus force majeure, where we mentioned it's usually just time unless it's amended?
No. So frustration is different. Frustration is a discharge of the contract. So force majeure, frustration, if it exists, means that the parties are no longer bound by the contract that they signed up to, so they don't incur the consequences that would otherwise happen. So in this case, you know, the point would be, well, the contractor simply can't pay the tenfold increase on steel prices, or you know, the works have been completely destroyed. And you know, I think you'll take from my comments that in both scenarios, my view was that frustration was a very high hurdle to clear, but it's really a sort of get out clause. It doesn't lead to time and money in the way that the claims under contracts where there are specific entitlements do. And so that's why it's important to ensure that you're covering off these points in the contract and refer to time and money, because, you know, these options of force majeure and frustration are necessarily fallback positions, but they're not particularly helpful.
Sure. Here's a question from Omar Saidi Khan. What happens when the project is delayed due to national fuel shortage? Due to a national fuel shortage, which subsequently results in delay of the offloading of laboratory equipment from the seaport by the contractor. So there's a supply chain question there.
Well, I think my answer would be similar to the points discussed. Unless there is a specific provision for what would happen in that eventuality, this is probably a force majeure type event, because it's a national shortage. It doesn't seem to be something either party was in control of, and so I would have thought if this is a FIDIC 99 contract, you know, as the one we've discussed here, then you're probably looking at a force majeure event, I would have thought. So contractor would get time but not money.
Yeah, sure. Here's a question, a broader question. We hear that the Chinese are pushing on with the Belt and Road Initiative, resulting in enormous infrastructure projects around the world, in different countries and in different cultures that will doubtless have some challenges. how do we address cultural differences in future contracts, and how can consistency of construction contracts be promoted globally across all cultures? I'll let John take a crack at that one to start with. How do we address cultural differences in
this is a really
markets?
interesting questions, but I would say using a standard form across all the contracts and put the proper risk allocations and explanations of the cases in general is one step on this direction. And then on the particular conditions, I think you need to study case by case in each country and find out if there is anything in this culture which need to be populated as particular conditions and plug it in. But in general, from my experience, for example, most of the, let's say, going with FIDIC contracts will satisfy a general need solving the construction activities. But the culture difference is a bit unique thing which need to be treated on a case-by-case basis.
Yes, of course, it takes a long time.
Yeah, exactly.
For all this information and new ways
yeah.
of doing things to filter around the world, doesn't it?
Yep.
Yeah, I think the only thing I'd add to that, Chris, is that this is why you have a contract, so that in theory everybody understands what they've signed up to, you know, no matter where in the world they might be from. But that in itself can give rise to issues. And, you know, anecdotally, the case that I dealt with a few years ago now was an English law case, but one of the parties was from a civil code jurisdiction in Europe, and the words good faith had been used in a particular clause. And if you're in a civil jurisdiction, good faith comes with a lot of meaning and interpretation, and I'm afraid to say under English law it really doesn't. And so we were in a situation where the common law position was completely at odds with what the civil code client thought they'd signed up to, even though they understood the words that have been written. So I think that that's one of those cultural areas where contracts can sort of, you know, trip you into a mistake if the words you're using actually don't reflect the meaning that you think those words have. And, you know, without trumpeting my own industry, that's why you should take legal advice on the contract before you sign it.
Sure.
Yeah.
And I think the premise of
sorry,
FIDIC,
Chris,
FIDIC
also,
was that it should be used internationally anyway. I mean,
yeah,
the whole idea of FIDIC was that it would be used all around the world for all probably major infrastructure projects in terms of the advocacy for it. So
yeah, and I have to say, I think it does a pretty good job of that.
Sorry, John, you were going to say something.
Yeah, there is also adding to this the issue about the country law, the country where you are doing the contract in law, and what is the applicable law and what law you have stated. In case of disputes, for example, if you are referring, I have seen this in a couple of contracts, especially in the Middle East, where they are referring to English courts, for example. And some parties, let's say a contractor from the Middle East will sign with a client coming from Europe or from UK, and he will sign, and then he will not realize at that point that the common law is treating some provisions differently. So he will just sign to a dispute provisions, which is to him, he understands it in a way, while it's actually the other way around. And this is a big thing which attributes to, that's why I'm reinforcing on Alex's message. Take a legal advice before signing a contract, especially on dispute provisions in particular.
Yeah.
Thank you, John. And we've got time for one more before I wrap up. Does the contractor have the right to slow or suspend progress until a dispute is resolved, especially if the disputed amounts are affecting the contractor's cash flow and progress? There's an interesting one, Alex.
Yeah, I mean, if you're in England and Wales, then yeah, the contractor can do that. We've got specific legislation that says if essentially the contractor hasn't been paid an amount to which they're entitled to, then they have the right to suspend the work until they are paid. So that in my experience tends to get reflected into contracts. So if you have that contractual right, then yes, it can be done. If the contractor doesn't have that contractual right to suspend, then it runs a very high risk in doing so, because it may pose the argument as to whether it's abandoned the work. And if it's abandoned the work, then typically that's a fundamental breach of contract. So it's not something that you would again do without advice. You'd need to make sure that you have the contractual entitlement to initiate the suspension. And if not, you'd be best advised not to.
Thank you, Alex. And how would that go down in Egypt, John? Does the contractor have the right to slow or suspend the progress until a dispute's resolved, especially if disputes and amounts are affecting the contractor's cash flow? I assume that means payments as well.
Yeah, I would say, again, we will refer to the contractual mechanism in this one, but let's assume that it's delaying his progress because of the cash flow issue. It doesn't create an impossibility to perform the contract. However, it's still an excessively onerous condition. So the contractor might continue working, but I would say at a slower pace, because if he is unable to recover his cash and produce, let's say, the required labor force and produce the required material on site and other equipments, then he will be delayed by all means. Again, this is why solving these claims or disputes at an early stage or trying to find a mitigation method is very important, especially in the current pandemic conditions and other delays and other factors contributing to this one.
Thank you, John. And I must say I'm afraid that's all we have time for today, everyone. So just to close, I'd like to thank the Chartered Institute of Building for supporting us and circulating the details of this webinar. Remember, if anything we discussed today raises questions or concerns on your project, please email us at advisory@gleeds.qa to see if we can help, or feel free to contact Alex or John directly. So we really hope this session has been valuable to everybody, and thank you very much to all of you from attending, and goodbye from Atlanta, Cairo, London, and Melbourne. Thank you.
Thanks, everybody.
Thank you.